Good morning and welcome. You're watching Market Cafe on ET Now. I am Harsh Saita. With me is Snehi Shah. Over the next hour or so, we'll take you through all that's happened on Monday in global markets as well as what factors to look out for when trading today. So, of course, we'll start off with what global markets are looking like, Snehi. You're looking largely at how global markets are indicating with regard to India, GIFT Nifty.
Absolutely, Harsh. So GIFT Nifty at 19,623. But let's kickstart the show with the global markets then. And let's start with Wall Street. US stock futures were near the flat line on Monday night as Wall Street assessed the impact and risks of a protracted conflict from the Israel-Hamas war. However, during Monday's trading session, stocks were initially lower, while the Nasdaq fell more than 1% during its session low before turning positive across the board. So we had some positivity coming from the US markets. The Dow added close to 200 points, or 0.6%. Nasdaq gained 0.4%. S&P 500 also added 0.6%. Amid the conflict, oil also saw an uptick. Energy and defense stocks also surged. Investors will be keeping an eye on the upcoming economic data. The NFIB Small Business Survey data from September will be released on Tuesday, as well as August wholesale inventories numbers. The Wall Street will also be closely watching PepsiCo's quarterly earnings results Tuesday before the bell. On the other hand, when we shift focus to the European markets have dipped on Monday as investors assess the impact of the geopolitical turmoil in the Middle East. Now, the Stock 600 index closed 0.3% lower, with travel and leisure stocks down 2.4% and retail stocks also taking a cut of almost 2%. Oil and gas stocks, however, were higher by 3% as crude oil prices surged. DAX was down 0.6% and FTSE came in largely flat. So, well, this is what the global markets were looking like. Green across the board when it comes to Wall Street, but largely red when it comes to the European markets. But Harsh, well, this was on the equity front. Take us through what the impact has been on oil so far. We are hearing that sanctions on Iran could be panning out very badly for oil prices. So take us through what oil did.
Well, yes, so oil, of course, rose sharply in trade on Monday, Snehi, and we saw that knee-jerk reaction come through yesterday. But we've seen a bit of softening since that point. So we've seen oil take around a 0.5% cut post that. So there's a slight bit of softening coming through on oil. Of course, the fighting between Hamas as well as Israel continues, and that always will put a spanner in the works when it comes to oil prices. That will also keep oil prices extremely volatile. But at least at the moment, what we're seeing is that sudden spike has been led by a slight bit of softening that's coming through. Also, with regard to the US dollar itself, we are seeing that not much of an impact on the dollar. It's come in around 105.7. That's where the dollar currently is sitting at. And you're looking at the US bond yields, which have crept up just about marginally. In fact, they had crept up just about marginally yesterday. They've come off from that around 4.8% mark. They've come in at 4.65 odd percent, at least as we speak. So we're seeing a little bit of yesterday's reaction being reversed, Snake.
Harsh, and let's shift focus from oil to natural gas, and because European natural gas futures have extended a rally after Chevron Corp shut down operations at a field in Israel, potentially squeezing supplies from West Asia. The benchmark contract surged as much as 17%, the most in 7 weeks. Chevron was asked by Israel to shut down the Tamar offshore natural gas platform because of safety concerns as fighting between Hamas and Israeli military rages for the third day.
Right. And sticking with that, let's bring you the latest on the Israel-Hamas war. Israel says its aerial bombardment of the Gaza Strip is one of the largest it has conducted on the besieged territory in the wake of intensifying tensions. Israeli PM Netanyahu has called Hamas savages in a video posted on X, assuring that his country will win this war against the Palestinian armed group. Meanwhile, the death toll has crossed the 1,500 mark, including hundreds of foreigners. The White House has come out expressing support for Israel, lighting up its facade in blue and white. Meanwhile, Saudi Arabia continues to express support for Palestine in its pursuit of legitimate rights. Let's hear out the video message released by Israeli Prime Minister Benjamin Netanyahu. Let's listen in.
Israel is at war. We didn't want this war. It was forced upon us in the most brutal and savage way. But though Israel didn't start this war, Israel will finish it. Once the Jewish people were stateless. Once the Jewish people were defenseless. No longer. Hamas will understand that by attacking us, they've made a mistake of historic proportions. We will exact a price that will be remembered by them and Israel's other enemies for decades to come. The savage attacks that Hamas perpetrated against innocent Israelis are mind-boggling, slaughtering families in their homes, massacring hundreds of young people at an outdoor festival, kidnapping scores of women, children, and elderly, even Holocaust survivors. Hamas terrorists bound, burned, and executed children. They are savages. Hamas is ISIS. And just as the forces of civilizations united to defeat ISIS, the forces of civilization must support Israel in defeating Hamas. I want to thank President Biden for his unequivocal support. I want to thank leaders across the world who are standing with Israel today. I want to thank the people and Congress of the United States of America. In fighting Hamas, Israel is not only fighting for its own people, it is fighting for every country that stands against barbarism. Israel will win this war. And when Israel wins, the entire civilized world wins.
All right, that's the word coming in from Benjamin Netanyahu. But let's stay with Israel because the central bank has sold $30 billion in foreign reserves and the country's currency, which is the shekel, has declined to a 7-year low. Now, the deadly incursion by Hamas and the declaration of war by Israel has plunged the Middle East in darkness. And there will be economic implications for the region, apart from the human cost, with the death toll already above 1,000. Let's listen into what these costs could be. Here's an explainer by my colleague Sumita Karir.
This war will take time. It will be difficult, Israel's Prime Minister Benjamin Netanyahu said after a murderous attack on Israel by Hamas that escalated into a full-blown war. Even though there's support to Israel from Britain and France, but a report claiming that Iranian security officials helped plan the attack increases the risk of it spiraling into a proxy regional war, and ramifications could be multi-pronged. Exactly what? Let's decode these one by one. Number one, the markets. Israel's benchmark index fell over 6% in the aftermath of the deadly attack. The shekel plunged to the weakest level since 2016 as investors dumped the local currency amidst uncertainty over ramifications of the conflict. A widening fiscal deficit on top of a war definitely doesn't help. Next up, global oil prices. Well, the fresh crisis in Israel rekindles the 1973 Yom Kippur War that pushed some Arab nations to impose an oil embargo on those nations that supported Israel in that conflict. That in turn triggered quadrupling of oil prices and led to a large-scale gasoline shortage through the developed world that includes the United States. Oil prices today as well went up around 4%. So this current crisis could mean a fresh oil crisis for the global economy, which could signal global central banks to spike interest rates, which are already dealing with high interest rates, which is the aftermath of the Russia-Ukraine conflict. Next up, the Saudi-Israel deal. The key motive being speculated for Hamas to have launched this surprise attack on Israel is to derail a possible deal to normalize Saudi Arabia and Israel's relations. This was being brokered by the United States and was close to being finalized. The Saudis see a potential deal with Israel to further their interests through security guarantees in return for establishing ties with Israel. For Israel, this would mean recognition by the most powerful Arab state of Saudi Arabia. The current conflict definitely is a setback for this process, and in future, if Iran's intervention is confirmed, then the US, according to experts, is likely to seek tightening sanctions on the nation's oil exports. Next up, the India-Middle East-Europe corridor. Well, the ambitious India-Middle East-Europe corridor to build shipping and railway links to ensure a free flow of commerce, energy and digital communication that involves Saudi Arabia could get impacted due to the crisis. Although it's a very long-term infrastructure project, but certainly it gets impacted if every country on the route is not on board. So it's still a developing situation in the region. Eventually, it all boils down to the fact whether the conflict is contained or it in fact widens in scope.
Right, interesting perspective coming in there, but let's quickly move on. Precious metals have rallied in trade as investors rush into safe haven assets amid the ongoing Israel-Hamas war. In fact, gold has risen nearly 1% or so in trade over yesterday alone, and of course prior to that as well, it was up. Bhavya Dua joins in with the details.
Gold prices surged over 1% in India on Monday as the conflict between Israel and Hamas increased political uncertainty in the Middle East. Heightened tensions in the Middle East have triggered a rush among investors towards safe haven assets, with gold leading the way. In response to one of the most devastating attacks in its history, Israel initiated a retaliatory offensive in Gaza Strip, resulting in substantial loss of life. The situation has since escalated, stoking concerns of a potentially broader conflict in the region. According to Indian Bullions and Gold Association, gold prices in Mumbai's spot market jumped about 1% to rupees 56,000 approximately per 10 gram for 24 carats. For 22 carats, rose about 1% to around 51,000 rupees per 10 gram. Likewise, silver rate today opened higher on MCX at around 68,000 per kg levels and went on to hit intraday high of around 69,000 per kg levels immediately after the opening bell today. In international markets, silver price is oscillating around $21.8 per ounce levels during Monday deals. The spiraling violence between Israel and Hamas threatens to start a major new war in the Middle East, sending oil prices higher and boosting the demand for safe haven assets like US Treasuries, the dollar, the Japanese yen, along with gold.
All right, thanks Bhavya for all of those details. The impact of the Hamas-Israel war is temporary. That's the word coming in from the Shipping Corporation of India CMD BK Tyagi. Let's listen in to his perspective on the current geopolitical setup and an excerpt of that conversation he had with my colleague Aishwarya. Listen in.
This is a momentary situation. Now all countries are very well matured and nobody can afford the war like war situation.
Concerns for shareholders of SCI has been the divestment process. How far has it come, and what kind of timelines are we expecting in terms of getting the bidders on board?
No shareholder should have any worry or any doubt or confusion. Government of India has decided this is going to happen for the good. And so shareholders, in fact, they will get much better value after disinvestment. But as I said, that this entire process is controlled by DIPAM, and DIPAM will be able to throw much better light. But this will happen for the good, that is for sure. Thank you.
But 2024 should be a good timeline to expect that?
Oh, yes, government, in fact, we must have read in the various newspaper also, they are targeting within this fiscal year.
Right. We'll start shifting focus now. A slew of job cuts are to be witnessed in the auto space after companies like Stellantis, General Motors have announced job cuts recently. Meanwhile, Ford has already slashed 70 workers, bringing the total to 1,865 workers being axed since the strike began. A total of 640 workers at Stellantis that have been laid off as well.
And let's keep it with autos then. And share of global auto major Tesla fell after company's EV sales in China nearly fell 11% year-on-year for the month of September. Sales for the Model 3 and Model Y vehicles made in China were down 12% from August to September. Remember, the dip in sales follows the news of their Q3 deliveries slipping sequentially.
Right, that time of the show where we slip into a very short break. Stay with us. We'll have Asian markets on the other side. Right, welcome back. Let's quickly take stock of what Asian markets are up to. Of course, US markets we did cover, but Asian markets have largely followed their US peers. In fact, we're seeing good green across Asia, 2% plus on the Nikkei. Good positivity. We're seeing the SX 200 as well as the Kospi, both in the green, 1% plus on the SX 200. Very similar number on the Kospi as well. You're seeing the Hang Seng as well as the Shanghai. The Hang Seng at first 2% higher on the Hang Seng as we speak, and the Shanghai as well up, but just about by a whisker, but still in the green, so that's positive. And what we're also seeing on the SGX Nifty is that it's indicating a slight positive start, which is definitely good, at least as we see it after yesterday. So overall, we're looking at green in Asia, that's positive. We're looking at positive global cues coming in, and therefore the gift nifty is pointing towards a positive start. Of course, as we get closer to 9:15 a.m., that direction will get more and more clear.
Absolutely, Harsh. Implied open around those levels versus the 19,512 levels we closed at yesterday. So indicating some positivity. Let's see how that pans out for us this morning. But let's also take you through all the important market voices as well as management. Hi there, welcome back, and thanks so much for staying tuned to Market Cafe. This is ET Now. Let's continue with the show then. And ET Now has learned from its sources that Cipla founders' stake sale may be delayed as there are disagreements among the founders. My colleague Anurag Joshi is joining in with all the exclusive details. Good morning, Anurag. Take it away.
The stake sale proposal in drug firm Cipla has hit a roadblock on differences among the promoters over reaching a common valuation. Now, these differences among the founders may lead to a delay in the deal until a common consensus is reached over the valuation. Cipla's founders over the last few months have been exploring the possibility of offloading their about 33.5% equity stake in the company. A group that holds 25% equity stake, and that includes the non-executive chairman YK Hamid, that has a view on the deal, and there's a divergent thinking on some issues from a promoter group that holds the balance about 8% equity stake in the company. Now, in the recent past, the suitors for the deal have included Torrent Pharmaceuticals, which has been seen as a key contenders, and that has put a non-binding bid for the stake. And the other contender besides Torrent is Dr. Reddy's Labs. PE firm Blackstone was earlier interested in the deal and had put in a non-binding bid, but withdrew the plan because of what it perceived to be the costly purchase cost for the transaction.
Right, thanks for that, Anurag. But let's quickly move on. The life insurance industry disclosed its numbers with regard to premium growth. Overall, you're looking at the first half of FY24 showing a growth of 13% year over year. September alone has grown 15% year over year, so definitely positive there. You're looking at overall the life insurance industry, HDFC Life, Exide Life, combined looking at an H1 growth of 15%. September seeing September seeing a growth of 8% on that count. When I'm looking at ICICI Pru, absolutely flat, in fact 2.3% down with regard to premium for the month of September. SBI Life also H1 seeing 24% growth, and September also seeing a 16% growth. That data point there, 16% growth seen in SBI Life for the month of September. Also, LIC has seen a degrowth on its numbers, 25% and 27.5% degrowth, both for H1 as well as for September respectively, and Max Life seeing a growth of 26% for H1 and 24% for September. So well clocked by Max Life on that count. That's the update on life insurance, Nehi.
Absolutely, Harsh. And let's shift focus to cricket then, because when it comes to the World Cup, it's not only about the game, isn't it? So it also creates so many jobs to the host country, which is India this time, and the ongoing World Cup is expected to create over 1 lakh jobs across various industries such as content creation, production and events in a span of 45 days. Hiring has also gone up by 20% versus last year. My colleague Sumita is joining us with more details on this and is breaking down these numbers for us. Sumita, take it away.
The ongoing World Cup will lead to the creation of over 1 lakh jobs over the 45-day period. That's according to some data that we've received from Team Lease. According to inputs shared also, the leading human resources company also states that overall hiring in the second half of this year will be up by 20%. And compared to around the same time last year, hiring saw an uptick of 10% last year. So this year's additional increase is primarily driven by robust domestic demand owing to easing inflation and green shoots appearing in rural markets and, of course, the World Cup. Along expected lines, e-commerce sector alone is expected to create 7 lakh additional jobs in H2 FY24, and 90% of these jobs will be gig jobs ranging from warehouse operations to last mile delivery. The remaining 10% jobs are support functions. Flipkart, for instance, talking of e-commerce companies, Flipkart will generate around 1 lakh jobs that it says will be created through its fulfillment and sortation centers and delivery hubs across the country, as it plans to deliver 4,000 shipments to even the remote parts of the country. But coming back to jobs spurred by a World Cup, in fact, the 1 lakh plus jobs estimate is driven by local phenomena around match days in cities where matches are scheduled to take place, with respect to demand for workers in hospitality, merchandising, facility management, field sales, etc. But there will also be a national spike during all match days with respect to demand for food delivery services, public establishments like sports bars, restaurants, and even local movie theatres, which telecast matches on big screens. And job creation will not be limited to the usual sectors like delivery, transportation, and hospitality, but new profiles are seeing a spurt as well. For instance, social media and content creation, bloggers, social media managers, merchandising and sponsorship, design, production, and distribution of sponsorship, merchandise materials. As far as media and broadcasting is concerned, there will be need for camera operators, production assistants, sound engineers, tourism, tour guides, drivers, hotel staff, event staffing, ushers, ticket takers, security guards, merchandise sellers, etc. So no surprises then, wages will also see an increase of 5 to 10% this year, even though salary increase for entry-level gig jobs has been in the lower end of this range. Although incentive-based payouts work better, and more firms hence are offering insurance coverage plans for this set of people.
Right. With that, let's slip into another very short break. We'll actually go straight into stock-specific news on the other side. Right, welcome back. You're watching Market Cafe on ET Now, and thanks for staying with us. Let's quickly look at all the stocks that will be in focus today on the back of news, and Ashesha is here with all the stocks and news.
Yes, first up, let's talk about a couple of operational updates, and Phoenix Mills is on the top of that list. It reported operational data for the quarter gone by, where retail consumption in the second quarter saw an uptick of about 20% on a year-on-year basis. The company also enjoyed increase in occupancy across sectors, both in leasing as well as trading occupancy saw an increase. So strong operational data has come in from Phoenix Mills. This counter will be in focus today. The residential portfolio too, steady traction in demand for ready units continued in the quarter gone by, with sales of about 292 crores in the second quarter, which is an uptick of a whopping 193% on a year-on-year basis. Strong operational data, this counter will be in focus. Let's also talk about KPI Green Energy, reported its numbers for the quarter gone by, where revenues stood at 215 crores, up 34% on a year-on-year basis. Margins, meanwhile, have largely remained stable, 33.12% versus 32.8% that the company had reported same time last year. Let's also talk about Genus Power Infrastructure. This counter in focus on the back of an order win, where the company said that they've won orders worth about 3,100 crores across business segments. Mazgaon Dock, meanwhile, again an order win, where the company said that they've signed letter of intent with a European client. This is to construct 10 hydropower vessels. On the back of order win, this counter will also be in focus today. Also keep an eye out on Prakash Industries on the back of two veteran investors making an entry into this counter, where Mukul Agarwal has acquired about 1.4% stake in the company, and Dolly Khanna has also acquired about 1% stake in the company. Meanwhile, Gensol Engineering, where Mukul Agarwal has made an entry into this counter as well with a 1.64% stake in the company. So on account of these shareholding changes that have happened, both of these counters will be in focus today.
Thanks, Ashesha, for taking us through all of those buzzers. We will be keeping an eye out on
all of those stocks today. Let's shift focus to pharma because Macquarie has come out with a note on the pharma sector. The house maintains an outperform rating on companies like Aurobindo Pharma, Lupin, as well as Alkem Labs. Vamakshi is here with all the details and the key takeaways from all of these brokerage notes. Good morning, Vamakshi. Take it away.
Well, yes, exactly. The pharma sector is expected to be in focus today. We have a note coming in from Macquarie, and what they have highlighted is that the drug shortages in the US market continue to climb. In fact, higher interest rates are creating headwinds for some of the generic manufacturers as well. Not just that, when we look at the competition, however, on the positive side, it has slightly reduced for the first time in the past decade. So given all of these factors, they believe that companies who have a meaningful US exposure towards the generic space are expected to benefit from the current scenario. In fact, they have given a pecking order in which they have highlighted Sun Pharma, Dr. Reddy's, Aurobindo Pharma, as well as Cipla and Lupin as some of their top picks. They've gone ahead and maintained their outperform rating on Aurobindo Pharma, Lupin, Alkem Labs, as well as Cipla, and also on all of these counters, they've gone ahead and hiked their target price. But not just that, they maintain an outperform rating on Sun Pharma with a target price of 1,275 rupees per share. Dr. Reddy's, they maintain an outperform rating with a target price of 6,300 rupees per share. They've maintained an underperform rating on Zydus Life Sciences, while for Ipca Labs, they've maintained a neutral call. So all in all, keep an eye out on the pharma space on the back of this report.
Right, thanks so much for that, Vamakshi. Shesha still with us. CNG sales continue to accelerate, hitting an all-time high at 61,000 units in the month of September. City gas distributors will see a rub-off from this news flow. Let's go across. Shesha, talk to us about this.
Well, yes, city gas distribution companies, the likes of IGL, MGL, Gujarat Gas will all be in focus today, and that is because CNG vehicle sales traction has continued in the month of September as well. CNG sales hit an all-time high of 61,000 units in the month of September, which is an uptick of about 71% on a year-on-year basis. As far as the passenger vehicle sale is concerned, CNG passenger vehicle market share reached double digits, so which is a positive for all of these city gas distribution companies. And remember, city gas vehicle prices were cut in the month of April this year, and since then, their market share has consistently risen on a month-on-month basis. Let's also talk about company-specific factors. Then first up, we'll talk about Gujarat Gas, where CNG vehicle registration in Gujarat Gas's geographical area was very strong in the month gone by at about 13,487 units, which is an uptick of 91% on a year-on-year basis. And CNG adoption has also risen to a record level of 28% on account of record performance across its segments. Meanwhile, as far as Mahanagar Gas is concerned, CNG vehicle registration at Mahanagar Gas's registration area has also seen an uptick of 41% on a year-on-year basis, with CNG adoption increasing to a record level of 33%. Meanwhile, as far as IGL is concerned, the trend has reversed. On a month-on-month basis, sales have declined by about 10%, although on a year-on-year basis, it continues to remain very strong with an uptick of about 20% on a YOY basis. What this means is that with petrol and diesel prices not expected to come down anytime soon, CNG attractiveness is expected to continue for some more time, and analysts believe that volumes for all of these city gas distribution companies, the likes of IGL, MGL, Gujarat Gas, are expected to continue to see sustained uptick from here on. So on the back of this data that has come in, all of these counters will be in focus today. Well, IGL, MGL and Gujarat Gas to be in focus today on the back of that news flow. Thanks, Shesha, so much for taking us through that. Let's shift focus and listen into a market voice then and listen into Vetri Subramaniam, who's the Chief Investment Officer at UTI AMC, on the various sectors that he's preferring and his outlook on the entire manufacturing space. Listen in.
I would say actually large cap valuations are sort of more in the fair value zone, though above the long-term average. But there are parts of the markets where valuations are challenging, and therefore, I would say buy the dip is too simplistic an approach in areas where valuations are challenging. I would say use the next year or two, even if rates are high, to build your core exposure in those large caps. I think that's where the valuation opportunity, to my mind, is slightly more comfortable. I always worry about valuations because, we've seen this before when stocks do extremely well and they put up the valuations. What are they actually doing? They are actually discounting the earnings that these companies can deliver in the future. And if you pull too much of that into the valuation, you actually depress your forward returns. So, that's my concern when we look at things like some of these manufacturing themes. Now, there could be one or two companies which still manage to pull it off. But when I see a generalized tendency for the whole sort of sector or an array of companies to start discounting a very rosy future, this to my mind has always been a precursor to the fact that future returns have been pulled into the present, and therefore the future returns actually get compromised. And those high valuations, go back, look at infrastructure 2007, even go back and look at how the IT sector was trading in 2020, 2021, when everybody said the whole world is tech. Look at the valuations they got, and then it's been a gradual descent down in terms of valuation. So that's my concern when we talk about this manufacturing opportunity. It may play out in the economy. I worry that the stock market has discounted it way too early. This is an area with multiple companies, all globally competitive in their right. We certainly like that area. But my approach toward this would actually come back to something you said earlier. I'd wait for those dips, because these stocks having coming to up to 52-week highs is actually, to my mind, not making it to be a particularly attractive entry opportunity. My sense is that the macro commentary out of the US will continue to remain slightly challenged, particularly because our companies have a big exposure to the banking and financial services sector. And, if bad news comes along, I'll be happy if the stocks dip to go in and buy them. So long term, these are a brilliant set of companies, but I'd like to have valuation comfort before I get into them. So large banks have been disappointing, but I do think the top 5 or 6 lending institutions in this country, their incremental market share is now close to almost 2/3 of incremental deposits and loans. And I think that's the place I would be very happy to back.
Right, that was Vetri, of course. But let's quickly move on to Saurabh Mukherjee's portfolio, right? And is the worst over for IT? Let's hear him out on that one.
Free ticket that I've heard of is gone. Not only are tickets gone, hotels are rammed, plane tickets are booked out, and I think this goes to show how wealthy a certain strata of Indian society has become. I would say not just the Indian upper middle class, but in general, in the big 10 cities of our country, levels of affluence and disposable income have reached close to first world levels. Which is why you're seeing ticket prices which are comparable, I would say, to say a football World Cup held in the Western world. So heartening to see this level of affluence in India's big cities.
Absolutely. And one has seen that affluence rub off on all the data points as well that we've been getting off late, be the property registrations, be the auto sales, all of it. You think this premiumization theme, Saurabh, is here to stay for a long, because a faction of the market also believes that what you could bet on right now is the rural recovery, because they are the ones which have underperformed for the last over a year or so.
I think there are 3 underlying drivers of wealth for, I call it the octopus class, right? Roughly a million super rich individuals. 3 underlying drivers. Firstly, obviously the stock market, right? The stock market's up nearly 18, 19x in the last 20 years. Anybody who's invested serious sums of money in the stock market over the last 20 years is on a rocket-propelled ship. Secondly, as the country networks, roads, airlines, broadband, the India stack, even small businesses who are competitive, small businesses in small town India are locking into the broader national economy. And it's very interesting that in our small and mid-cap portfolios, some of the best companies are no longer in the big 4 or 5 metros. They're in the next 20, 30 cities. And the rise of an integrated national economy is driving an SME class. And the third aspect, I think, is the rise of what I call global capability centers. We have roughly 1,600 GCCs in India. These are companies and these are global companies, India offices, but this is also, say, a Google or a Microsoft's programming centers in Hyderabad and Bangalore. Our reckoning is, Aisha, that this number is growing by 20% every year. Pretty much every day a GCC is opening up in India. That itself will create around 4-5 million jobs, affluent, high-income jobs. And this combination of the whole world's, not just IT services, but payroll, finance, marketing, audit, all of that work being done in India will create a deeper layer of affluence in Bombay, Bangalore, Hyderabad, Gurgaon, but also increasingly cities like Coimbatore, Nashik, Indore. These cities are becoming big hubs for global work. So three massive drivers of affluence for premium India. The lower income strata is a different story. I think the FMCG company struggles you were highlighting a few minutes ago tells that part of India is struggling. But upper middle class India, Octopus India, as I call it, is absolutely booming.
Oh, yes, indeed. And even with the kind of inflated prices that we've seen for hotels, airlines, etc., not just for the World Cup, but people are really willing to shell it out for those great experiences. Which brings me, Saurabh, to just get in your quick take as well as to how you're looking at, say the food aggregator space or the entire consumption sector really getting a big pickup, of course, from a big event like this and, sort of sustaining that momentum. Do you think that that is looking achievable? Because, say, in 2019, it was the likes of a Jubilant that really took the lead when it came to a big event like the World Cup. But now it seems to be a lot of other players as well that are dominating this space.
So in the food aggregator space, I agree with you that there'll be a volume uptake is all but inevitable given the scale of the World Cup. But the challenge, I think, in food aggregation and generally in much of the digital space in India is bargaining power, is comparative advantages and the ability to translate volumes into profits and cash flows. I think that remains a struggle for food aggregators generally and the digital online space in our country. Where we think the biggest profits will be made is supplying the critical inputs which go into the food industry. So, for example, in our small and in our mid-cap portfolios, Little Champs and Rising Giants, we are big shareholders in Fine Organics. Fine Organics supplies the emulsifiers, a significant number of the additives which go into biscuits and snacks that we have on a day-to-day basis. It goes into our fizzy drinks that we have on a day-to-day basis. That's where the big kickers will come. Companies which have established almost dominant hammerlock into the raw materials which go into our foods. And if you see Fine Organics' return on capital, it's around the 35% mark, suggesting deep dominance of some of the essential inputs which go into the stuff that we eat on a day-to-day basis, our snacks and our fizzy drinks.
All right, that's the word coming in from Saurabh Mukherjee. But with that, I'm afraid we're completely out of time on this edition of Market Cafe. While we bid you goodbye, you don't go anywhere. Stay put on the channel because the market takes all the action ahead.